what I'm going to do, first of all, is turn off the, and let's spread this out. Let's get this really wide. Now, here is we're looking at the July with 2 days to go. And it's got a certain amount of slope on the white one, right? Now let's turn that off and turn on the August. It's a lot flatter. So it's not as sensitive. So this bought the woman time, and it bounced, and she was able to scalp out of that. But it was better to go into expiration with that vertical, and she covered the other vertical, the short call spread, which actually went into the money, by the way, that day. But it was, wow. It was, she didn't do bad. She was able to, you know, take a tinier loss because she was able to weather the storm. That's the point I want to make. You roll that bad vertical. That's when it's going bad. You roll the bad vertical to another month or away, depending on how much time to go. So this is some information. Here, let's go to some questions. I'm going to be doing a program in August, 5 weeks live. I'm going to find, that's why, let's go back. We're going to find 3 trades, one aiming north, one aiming south, one aiming sideways, and we're going to manage it over time, just like we did the Google, like I did with my private clients. And we're going to do this, and you have an opportunity to get that for a discount. Matthew will send you the link to go to that. It's discounted. All right, and there's 2 packages. One was just the lectures, and the other has a few $1,000s worth of my other videos and courses and software. Not these versions, but another version of Diamonmetrics and another version of Position Dissector included in that, so that you can bone up for when we get together August 11th and a week later and a week later and a week later for 5 weeks and manage this over time. And if we still have it on, you'll be able to follow it in the forums, and I'll make little mini videos, etc. All right, so let's see if we covered some of these questions that were sent to me. So we're past the time, but I'll start off with these questions, and you could start asking questions, and Matthew will filter them to me. But let me start with these, because Matthew sent me these before. So I'll address each one of these. This is just a copy and paste of what Matthew has written. So let me get these a little bit bigger. All right, please go over strike selection to use when initiating BWB and how to adjust. I think I did that. Number 2, what is the best way to protect yourself against a May 6th flash crash? Those that made that happen will do it again and again because they can. Well, I just showed you, you could roll away like this woman was doing, first down lower strikes, and then move it to the next month. And if the verticals are right between the money, you can do it for even money. If it's north of the bad place, you'll get a little bit of a credit. If it's south, like the example I just pulled up, where one was 11 and the 11 and change, the other was 10, it's going to be a debit. So north or south of that midpoint, you know, obviously north of that midpoint in the case of a put spread, you're going to do it for a credit. But either way, you're going to get cushion. You're going to be able to survive it going all the way to $20, the difference. Best exit strategy. Ooh. Well, the best exit strategy would probably be that manly man in Google, if he could ride it to expiration, but it would be the worst if he was doing the Apple trade. So you saw my reasons for systematically removing the quantities of butterflies. One point I should have made, let's go back to where things really changed in my butterfly counts. So let me just go back to here. Let's just zoom back here. I think I might have it just in some of these dissections. Now this shows after the night. Let's see. I want to go to where look here after the 7th trade. I had 320 butterflies, and by those trades, trades 8 and 9 had gotten it down to 80 butterflies. I'm systematically removing dough from the table, and then down to 40 butterflies, and by trade 9, and to still 40 butterflies, but slightly different than 10, and then down to 20, and then down to 10, and I was taking money off the table. This made $16,000, out of the 30,000 initial risk, but certainly, as you recall, it was a lot less risk along the way. Okay, back to the next question. Mending is complex and seems to require a lot of skill. And typical student to master this, well, the odds in his favor. You know, I don't know how many we were able to follow what I was doing, but certainly the Risk Illustrator software changes the whole game. It makes it so clear. It helps a lot. I mean, you're not going to be an expert, you know, the day after you fire it up, but after a few explorations and sharing some information in the forums with your friends and whatnot, you could fine-tune this in a pretty short, in a few weeks, I would have thought. Definitely in a couple explorations. So that's, you need the transparency of it all, really, is the answer to that one. Assuming I put on a BWB for a credit using out-of-the-money shorts on both sides of the price action, what would be the best time to adjust them, either with vertical or another fly, and how do I determine the appropriate price to pay for the adjustment? Well, I think you saw that I was monitoring value the whole way and figuring out how much money I was taking off the table and paying for certain little short-term legs here and there. When you play both sides of the market, which I don't particularly like to do, I like to pick one side. I'm a technical analyst. I've been doing diamometrics in one variation or another since 1988 when I first invented it. So I gravitate more to that. But how would I? Again, I would use support resistance. And if I broke resistance, I would say, I'm wrong, and do something about the north side, because that's where I'm in danger. If we broke support, I would say, I'm wrong, and I would buy back some of that downside danger. I think I kind of went over basically what to do there. Number 6, although rules are personal, could you please discuss a couple that might be useful guide? Rules. I told you a bunch of stuff of what I do and what I don't do. I don't have rule number 1, rule number 2, rule number 3, like some of the other educators out there. So, you know, I'm a little bit. I have some very hard and fast rules, but not like a boot camp set of 10 or for something like that. 7. What is your view of risk-reward potential of following a long long-short hedge strategy using value line options, surveys, maintaining several long positions and an equal number of short positions using value line buy-sell criteria for undervalue over value options? I went to this link. I found this link that's in your PDF, and I saw that basically they're showing high vol situations, sell calls or sell puts, low vol on the ones that you're buy options when it's low vol. They say when you're bullish and it's low vol, buy calls, and it's bearish and it's low vol, buy puts. When it's bullish and high vol, sell puts, and when it's bearish and high vol, sell calls. That's all they're doing over there, and they create a portfolio like that. And I don't trade that way. I use support resistance first of all. So I don't believe in that, and it doesn't have any application to spreads. Those are just, you know, you could sell a high in a high vol situation, sell an out of money vertical, you're going to get a little bit more than you normally would, but I don't think, you know, they rank 1, 2, 3, 4, 5, 1 being a great buy, 5 being a great sell, 3 being get out. So I found fault with, or just, let's see, page 43 said, for instance, over 5 years ending September 2006, cumulative logs showed our rank 1 covered calls gaining 95% and our a loss of 296 for rank 3 naked call writing. So obviously it makes sense to do the ranked 1 number call, you know, but it's pretty simplistic, and I don't think they had any, I couldn't find anything very solid about what they do.
Just so everyone can see where to go to get this special offer that we have going on. If you go to our website and just click on member-only offers trading tools in the top navigation, Just click on that, and that'll take you to a page. Just go to the bottom of the page, and you'll see a picture of Charles there. Just click on that, and you'll see the two offers that he has for you today. So these offers apply until July 28th. So the first one has his complete package for 37% off the retail price. So the early bird discounted price, which applies for 1 week. So midnight the 28th that expires, it would be $2,000 for that. And option number 2, which is the webinar only, would be 20% off the retail price, and that's $7.99. Both of those will expire on the 28th. So if you'd like to take advantage of either of those, just click on add to cart on either of these, and that'll take you to Charles's website where you can complete your order for that as well. And I'll send out an email as well. And Charles and we're both recording this webinar today, and I'm sure he'll be posting it somewhere. We will be posting it on our site, and we'll send out an email once it is ready, along with the new PDF once Charles gets that out to us, so that all of you can have that for reference. Okay, so anyway, if you have questions, type it into the Q&A window or raise your hand, and I will unmute you when we come around to you. Okay, so let's start with a question that was typed in. We've got one from Paul Halloran. His question is, how do you decide whether a fly is cheap or expensive?
Well, you can tell by that butterfly curve what it is in relationship to all the others, and you know that over time they increase. So it's just a sense you develop over time, but you can see it graphically using that butterfly arc that I showed on pages, I think it was 53 to 62 or something like that.
Okay, next question is from Stanley Shelliam. What is the significance of a box?
Well, a box is just a neutral position that sometimes gets embedded depending on whether you traded call verticals or put verticals. So it's a result of trading. It's nothing to trade if you don't have to, but it's something that can be used, again, at the end for a pin risk, as I explained, but it turns out I only needed to buy the bad corner, that 20 lot that was just out of the money going for a dime. But it's something that you need to be cognizant only at the end. But the only other main thing to keep aware of is that an iron butterfly's credit is only different than a regular butterfly's debit by the embedded sale of a box. So you're fooling yourself if you think that somehow a credit is better than a debit. In a lot of cases, a credit is never better than a debit with regard to that, because you're probably not getting the interest on the money that because a box is a discount instrument. So if you have one short embedded in your position that's growing to full value, you're going to have the clearing firm giving you interest on your money, or your brokerage firm giving you interest on your credit balance in order to make up what you're giving away on that growing. That's a Chapter 3 thing and a Chapter 8 thing in my book. It goes into more details. For most retail traders, you only have to be concerned about it for pin risk and to understand that there's nothing magical about a credit versus a debit.